everybody, it's Riley with the Tessier team. I am the Director of Operations, and today I have our trusted lender partner, Lexi Albert, here from First Home Mortgage, and we're going to talk a little bit more about lending products. We're going to talk about, what can people afford right now in today's market, and, just get your questions answered around affordability. So a lot of my friends run in that 85 to like 100 grand range for like income, and a lot of them are wondering, what can they afford?
Yeah, absolutely. So obviously it does vary depending on, the situation of the borrower, depending on your debts. But just for sake of an example, monthly debts include your car payment, student loans, any revolving debts that you have, like credit cards as well, and then any kind of personal loans. Utilities, cell phone bill, anything like that, that is not your debts. Okay. So for the sake of this, I will just use $350 for student loan payment, car payment, and then about $100 minimum payment on a credit card. Okay. So that's about $750 monthly in your debts. So if we're doing $85,000 a year, that gets us monthly at around $7,083 a month. Okay. So whenever we're qualifying, we always go off of gross income. So that's prior to any taxes or benefits, 401k, anything being taken out. We don't like to see any more than 50% of your gross monthly income going towards your monthly debts. We take that total of $3,500, subtract out the monthly debts you currently have of around $750, and then your whatever's left over is your max mortgage payment you're able to qualify for. Okay. This is assuming the total mortgage payment. So that is your taxes, insurance, mortgage insurance, and then obviously your principal and interest. Right. So there are 4 things that go into that payment. After you take out the $750 a month in your current debts, you have about $2,700 to play with for your mortgage on what you can max qualify for. So in this scenario, obviously, first-time home buyer making around $85,000, they're probably not going to have a ton of cash to bring for down payment. So I'm running this off of, a 3% down payment. Typically, 3% down with closing costs on around a $350,000 loan or purchase price, you're looking at around mid to high 20s for your closing costs, $20,000 range. Okay. So once again, with a $2,700 a month payment for a mortgage that you're able to qualify for, backing that out, that gets you to a purchase price of around $335,000 with a 3% down payment.
I mean, that's super digestible. I mean, I feel like, single people feel like they are taken out of the market because they don't have affordability. And, that's a great price range, especially in county versus the city. You get a little bit more flexibility with kind of what you can buy. So it's good to know that. I think that people are scared right now to make that decision. So what would you tell someone who's maybe, getting their feet wet into this market right now? Like some things maybe to not do, some things to avoid?
Yeah, I think the biggest thing I tell people is do not buy a car when you are looking to purchase a home. Personally, when I bought my home, gosh, I think it was 2 years ago, I had a little Volkswagen, no car payment, and I was like, I'm riding this thing out until I can't anymore so I can afford a house. And if I would have had a car payment, I probably my purchase price would have been about $60,000 less a month, or
that's crazy
on the purchase price.
If you really think about that.
Yeah, your buying power changes by that much because of a car payment. Yeah. So if you're looking to purchase, don't buy like new car, right. Or just be reasonable when you're buying a car. Don't get a crazy payment. That's the biggest thing I've seen.
Is a lot of debt like on credit card, like kind of how is that foreseen? Like, I mean, our credit right now as like a country is pretty high. It's millions, right? As a whole. So, how can you offset? Is it better to kind of get your credit ready to go before you step in, or like to really get some, down credit?
Yeah, get your balances down. Yeah. So honestly, like a big factor when we're running your credit is, I think it's 35% of your credit score is for your revolving utilization. Don't quote me on that. I think it's around 35%. So if you have more than 10 to 20% of your credit card balances, charge, then it's going to affect your credit score. So if you have high balances on your card, try to work on knocking that down to a more palatable percentage. Yep. Once again, like we don't want to see maxed out credit cards, because when we see that, we're like, well, obviously, this person is spending more than they have. Got it. So credit card debt's okay. It's just definitely try to chip away at it. I will say it's not the biggest thing that I see keep people from qualifying because we only use the minimum payment when we're qualifying. So the minimum payment, on a lower balance credit card, typically I see like $40 to $80 a month. So, and they can have about $5,000 on their card, and we're only counting $40 to $80 a month.
Huh, that's a good tip. I didn't realize that.
Yeah, so I would say definitely the biggest thing is don't buy a new car, and then second thing, just chip away at that credit card debt. But that's kind of the biggest things as far as getting your credit ready. If you think your credit's in a spot like in the 600s or something, or you don't really know where your credit is, we work with loan readiness specialists who are able to do soft pulls on your credit as well. So we have partners that are able to do that, and it's a free consultation. So I always say, if you're even on the fence about buying, just go ahead and get that started up front.
Right.
So then you're not scrambling at the last minute to put an offer in and try and get pre-approved.
I think that's such a good point, because I think that buyers tell themselves a story because the media has said it's either a good time or a bad time to buy. But ultimately, our team says that it all depends on your specific situation. So until you really have all the facts and you're really understanding your financial acumen, you can't make a decision.
Yeah, no.
Time to buy or not.
And my thing is, if you don't get pre-approved, you don't have a benchmark to go off of. So you're looking at these houses that you might not be able to afford, and you're getting your hopes up, or you're looking at houses that you're way overqualified for and you can get something nicer.
True.
So I always say, if you're even just considering it, just talk to a loan officer and just get an idea of where you're at financially. When you're looking at your credit score, also big thing that we run into, all my borrowers look at Credit Karma, and that's a consumer credit report. So typically what your Credit Karma says, our credit score is going to be about 20 points lower because we're doing a mortgage credit report. So it's going to vary a little bit. But yeah, my biggest thing is, if you're looking to buy, or even just have the idea of maybe I should look into this, just talk to a loan officer and just get started. It is free up front for a lot of loan officers. From company to company, it may vary, but for us, it is free up front to at least just have a conversation.
Right.
So
I think that's great. I mean, everybody should really take that first step. I mean, if you have any specific questions about, lending products or anything, specific to you and your situation, reach out to us at the office or Lexi here at First Home, but we're here to help if you have any questions and getting into this market.